Artificial intelligence has become the new gold rush. Investors aren't just excited, they're obsessed. People are pouring money into anything that sounds remotely connected to artificial intelligence, convinced it will reshape the entire world. Stock prices are skyrocketing not because of earnings or profits or fundamentals, but because the letters A and I appear somewhere in a press release. Companies that struggled for years suddenly see their shares double overnight the moment they claim to be pivoting to AI. Does that sound familiar? It's because we've seen this story before. Back in the year 2000, the magic word wasn't AI, it was .com, and the world was just as certain, just as euphoric, that a new technology would rewrite the rules of the economy. Today, in 2025, we're watching a new version of that mania unfold. AI is real. The technology is powerful, but the market built around it? That's where things start to look dangerously unstable. Today, the entire financial system is being pulled upward by a tiny group of massive tech companies, while the real economy lags far behind. And if you look closely, the signs of a bubble are already flashing. To understand what's happening today, it's helpful to revisit the dot-com era itself. The late 1990s produced a level of enthusiasm that markets weren't prepared for. The internet felt limitless, unstoppable, inevitable. Investors believed it wasn't just a new industry, but the dawn of a new civilization. And all a company needed to tap into that mania was a website, or even just a name change that included .com. That period wasn't built on profitability or sustainable growth. It was built on expectations, wild, unchecked expectations. Venture capital poured into startups at an unprecedented pace. A tiny team with a website and a vague business plan could raise millions overnight. Many companies had no earnings, no clear path to profitability, and sometimes no real product. But their stock prices soared anyway. And the more speculative the idea, the more investors loved it. Companies raced to IPO not because they were ready, but because the market rewarded hype over execution. Marketing replaced fundamentals, growth projections replaced cash flow, and in a phenomenon that now feels almost absurd, stock prices jumped simply because a company added .com to its name. Restaurants, retail shops, service companies. It didn't matter if it sounded internet-related, it became gold. The media fueled the frenzy. Financial news networks ran constant coverage of overnight millionaires. Analysts projected a future where every company would either become an internet company or be destroyed by one. It was a culture intoxicated by speed, the belief that technology had made business cycles obsolete. And when the bubble burst in 2000, billions in wealth evaporated almost overnight. The lesson seemed clear. When valuations disconnect from reality, gravity eventually returns. Yet a generation later, many of the same patterns have returned with a new face. Which brings us to the year 2025. This isn't just another chapter in tech evolution. This is the AI era, an era that investors believe will dwarf anything that came before it. But beneath the excitement lies something more fragile. Markets today are not rising on broad economic strength. They're rising because of a single cluster of companies known as the Magnificent Seven. These companies aren't just influential, they dominate nearly every major index. Without them, the stock market looks flat, or in some cases, negative. It's the kind of concentration that makes the entire system dependent on the performance of just a few giants. In 2025, over 30% of the S&P 500's value comes from these 7 companies alone. Nvidia has become so central to the AI boom that one disappointing earnings report can send global markets into a tailspin. Apple, Meta, Google. Each of their quarterly reports has effectively become a macroeconomic event. When so much weight sits on so few shoulders, the balance becomes precarious. And then there's the issue of valuations. Today's price-to-earnings ratios stretch far beyond historical norms. Several AI-exposed stocks trade at levels that imply decades of flawless execution. Meanwhile, real economic growth remains modest, nowhere near the pace implied by soaring stock prices. It's a widening gap, one that feels eerily similar to early 2000. Even more striking is the psychological behavior surrounding AI. A company doesn't need a breakthrough product or a competitive edge. All it takes is a single announcement: we are integrating AI into our strategy, and the stock price jumps, sometimes dramatically. This mirrors the dot-com mania almost perfectly. The terminology has changed, but the human behavior hasn't. Investors aren't evaluating business models, they're chasing a dream. And dreams historically are terrible risk managers. And this brings us to the risks. Because while the hype itself is dangerous, the broader economic backdrop makes 2025 even more vulnerable than 2000. When valuations are this inflated, the downside potential becomes enormous. If just one of the major tech players, say Nvidia or Alphabet, shows even a hint of weakness, markets could react violently. A correction in one company can trigger margin calls, forced selling, and systemic pressure. The risks deepen when you consider monetary policy. For the last 3 years, the Federal Reserve has been aggressively tightening financial conditions in an attempt to control inflation. Rate hikes take time to work their way through the system, and by 2025, real damage may have already been done beneath the surface. Businesses face higher borrowing costs, banks are more cautious, and credit is harder to obtain. These stresses often accumulate quietly, then erupt suddenly. As lending slows, companies, especially those without strong cash reserves, begin to struggle. They cut investments, reduce hiring, and eventually resort to layoffs. This process can escalate quickly, rippling through the economy. And because the market's strength is so concentrated at the top, weakness in the broader economy can go unnoticed until it's too late. In previous downturns, central banks stepped in early and decisively. During the COVID shock, they did exactly that, cutting policy rates to historic lows, launching massive asset purchase programs, and extending special liquidity facilities to keep credit flowing and markets functioning. Those interventions played a large role in stabilizing bond markets and bank funding during 2020 to 2021. But 2025 presents a unique challenge. The scale and persistence of pandemic-era stimulus, both fiscal and monetary, helped to rebuild demand quickly. And when that recovery met supply bottlenecks, it contributed to an unusually large inflation episode that central banks have spent the last 3 years trying to unwind. Because of that recent history, many policymakers are more reluctant to re-engage the kind of aggressive, balance sheet expanding easing they used in 2020. Restarting broad quantitative easing now risks reigniting inflationary pressures or unanchoring inflation expectations at a time when central bank credibility is still being repaired. At the same time, doing nothing also carries obvious risks. Monetary policy works with long and variable lags. Research shows the real effects on output and prices can take many months, and in some cases even years to fully play out. So by the time damage from tighter financial conditions shows up in unemployment or corporate stress, it may already be deep and widespread. That lag means policymakers face a genuine timing problem. Cut too soon and inflation could reaccelerate. Or wait too long and financial strains might cascade into credit freezes, large bankruptcies, and a prolonged downturn. The trade-offs are made messier by balance sheet realities. Central banks that bought huge amounts of government and corporate bonds now carry large balance sheets, and in some jurisdictions have experienced negative carry or accounting losses while normalizing policy. Factors that complicate the optics and operational choices around restarting asset purchases. Add to that the political and reputational constraints after a period of hot inflation, and you get cautious policymakers who are rightly worried about both inflation reaccelerating and systemic financial stress emerging beneath the surface. All the while, markets continue to bid up AI-related valuations on narratives and expectations rather than profits or cash flows. That combination, elevated asset prices concentrated in a few sectors, tighter credit conditions for the broader economy, and central banks with limited appetite for another big easing cycle, creates a narrow margin for error. Policymakers are effectively trapped between two dangers: stimulate too soon and risk reigniting inflation, or wait too long and allow financial weaknesses to deepen. That delicate balance is a big reason why this moment feels especially unstable. And the deeper question is whether we're experiencing an AI bubble. The technology is transformative. No serious analyst doubts that. But even world-changing technologies go through cycles of excessive hype. Railroads did. Radio did. The internet did. The pattern is always the same. Innovation sparks excitement. Excitement drives speculation. Speculation inflates valuations, and eventually reality forces a correction. AI is following that rhythm with uncanny accuracy. Look around the financial world today. Extreme concentration in a handful of companies. Stretched valuations. An economy that isn't growing nearly as fast as the market. Higher interest rates. Tightening credit, and central banks with limited tools. These are not the conditions of a stable system. These are the conditions of one that is stretched thin. A major downturn might not require a massive trigger. It could start with a single disappointing earnings call, a geopolitical event, or even a small credit freeze. Large bubbles often burst not because of a catastrophic event, but because the internal pressure becomes too great for the system to hold. So the question isn't whether AI is real. Of course it is. The question is whether the financial expectations built around it are realistic. or whether they're the product of the same optimism and speculative energy that fueled the dot-com bubble. History doesn't repeat itself exactly, but in 2025 it feels like it's rhyming louder than ever. Are we witnessing the early stages of the next major crash? Or is AI powerful enough to justify the extraordinary valuations we see today? Leave a comment below and don't forget to like this video if you enjoyed the content.